Gold isn't telling you the truth right now. The spread is, and it's screaming that the debt problem is starting to leak into price discovery. The comforting story is that gold is just reacting to headlines, that it's a sentiment trade, that it's a crowded fear bid you can fade when the mood improves. That story exists for a reason. It keeps people calm. It keeps portfolios anchored. It keeps the bond market looking like a boring machine instead of a political variable. But the market has a different message, and if you know where to look, you can see the mechanism that turns a normal rally into a repricing that doesn't stop at neat round numbers. And later in this video, I'm going to give you the two levels that matter most, the one signal that confirms the squeeze is still alive, and the one level that, if it breaks, changes the entire math of the $600 path. Start with what's on the screen, because the tape itself is part of the evidence. Gold didn't float higher this month. It stepped. It printed the kind of stair steps you see when liquidity thins, and someone is forced to pay up in size instead of patiently working orders. Early January was already elevated, then it accelerated, moving from the low to mid 4,000s at the start of the month to flirting with the upper 4,000s into late January. Spot pricing has been hovering around the high 4,000s right now, with screens showing roughly the $4,900 area. That kind of move isn't just people feeling bullish. That's positioning getting stressed. That's hedges getting chased. That's the market discovering that the offer is not as deep as everyone assumed. And that's where the real pressure starts. Here's the conflict. When gold rises like this, institutions have two incentives that collide. First, they want to keep the narrative clean. Gold up because of geopolitical uncertainty. Inflation worries. Rate expectations. Nice, tidy boxes. Second, they need to manage risk in products that are structurally short volatility or structurally sensitive to gold's upside. That means they need the move to look emotional, temporary, mean revertible. Because if you admit it's debt math, if you admit it's about collateral trust and fiscal credibility, you're admitting it's not a one-week trade. You're admitting it's a regime, and regimes don't give your book permission to relax. But that's not the part that matters. The part that matters is that gold isn't one market. It's two markets stitched together, and when stress hits, the seam shows. You have the paper layer, futures, options, OTC forwards, where price is discovered on screens, where leverage exists, where hedging is mechanical, where a lot of volume is really risk transfer. Then you have the physical layer, refiners, vaults, bars, jewelry demand, central banks, industrial users, where you can't print new ounces because the chart looks bullish. The paper layer can move fast. The physical layer moves slow, but it has a veto. And when the physical layer starts to pull on the paper layer, you see it in one place before you see it in the headline price. You see it in time. You see it in carry. You see it in spreads. Because if the market is calm, gold usually carries like a normal asset. Storing it and financing it costs money, so future prices are often a bit higher than spot. That's contango, that's the carry story. But when the market is tight or stressed, the nearby contract can get bid relative to deferred because immediacy becomes valuable. That's backwardation pressure. And gold historically doesn't love living in backwardation for long unless something is off in financing, availability, or urgency. The price can lie. The spread doesn't have the same freedom. Because if this one relationship breaks, the math changes. Now let's connect that to the title. A debt crisis pushing gold towards $6,100. That number sounds dramatic, and it's supposed to. But here's the thing. Gold doesn't need a Hollywood-style crisis to move another $1,000+ from here. It needs a sequence of very ordinary mechanical behaviors that, stacked together, create extraordinary outcomes. One flow turns into another. One hedge becomes another hedge. One spread forces another spread. And the moment that change starts, people who only watch headlines feel like the move came out of nowhere. It didn't. It just came from plumbing instead of emotions. Debt is supposed to be boring. Sovereign debt is supposed to be the safest collateral in the system. It's the thing you discount, not the thing you debate. But the moment interest expense becomes a political issue, when servicing costs grow, when refinancing needs come due, when the market starts to ask who absorbs the supply at what yield, debt stops being just finance. It becomes policy. And policy, by definition, is unstable because it can change with speeches, elections, emergency meetings, and optics. That's why gold responds. Not because gold is scared of a single event. Because gold is a hedge against rule changes. It's the asset you own when you suspect the scoreboard might get adjusted mid-game. And the next detail is what flips the whole setup. One of the cleanest real-world signals is what central banks do. They don't buy gold because they watched a YouTube chart. They buy gold when they want assets that can to be frozen by someone else, this legal framework, when they want reserves that aren't someone else's liability, when they want diversification away from the same set of sovereign paper everyone else holds. Over the last few years, central bank demand has been unusually persistent, including reported buying north of 1,000 tons in a year, repeated across multiple years. That's not a one-off. That's structural. That's an institution-level admission that something about the reserve regime has changed. And when official sector demand becomes a steady bid, it changes the supply-demand floor under gold. It doesn't guarantee a straight line up. It changes the shape of the downside. That's a huge difference. Now layer in the gateway effect of modern markets, ETFs and ETPs. When Western ETFs are bleeding, gold can feel heavy, even if the physical story is fine because paper supply keeps hitting. But when ETFs flip from leakage to accumulation, price discovery changes. The marginal buyer becomes someone who buys for allocation, not for jewelry. Someone who buys because their model says add hard assets, not because they need to manufacture rings. And that's when moves get cleaner and faster. Because the flow is simpler. Cash comes in, metal gets sourced, vaults get allocated, and the paper market has to adjust to reflect that demand. The tape starts to look like urgent procurement instead of casual speculation. But that's not the part that matters either. What matters is what the options market does when price approaches certain levels. People hear gamma squeeze and think meme stocks. That's lazy. The mechanic is older than social media. When a lot of options are written at key strikes, market makers hedge their exposure by buying or selling the underlying as price moves. If price rises toward a strike where there's heavy open interest, the hedging can become reflexive. In simple terms, the higher it goes, the more they have to buy to stay hedged. That doesn't create the trend from nothing. It amplifies the trend that already exists. It turns a crawl into a sprint. It turns a retest into a breakout. And those chunky candles you see, those bursts where gold leaps, can be the footprint of hedging flows fighting thin liquidity. That's why rallies often accelerate into expiries, into month end, into windows where dealers can't just sit there and hope it calms down. They have to act. They have to buy. And that forced buying doesn't care if the headline tone is mixed. It cares if the math says, hedge now. Which brings us to the calendar trigger, because why now is not optional. Right now, the market is sitting in a zone where month-end behavior and options behavior can matter more than whatever the talking heads are debating. Month-end and quarter-end don't just change the calendar, they change mandates. Funds rebalance, risk models reset, dealers roll hedges. And in commodities, delivery windows and roll periods create their own gravity. When liquidity is thinner, around holidays, around weekend gaps, around sessions where participation drops, moves can become more violent because there's less cushion. This is when gold can gap. This is when stops can get run. This is when the market can force you to make a decision at the worst possible price. And that's exactly what volatility is designed to do. Now, the hidden detail we teased earlier, carrying costs, spreads, and the cost of time. If you want to know whether this move is just a screen story or a structural story, you watch what it costs to carry gold through time. In a calm market, you can buy spot, finance it, store it, and sell forward for a small spread that reflects rates and storage. When stress enters, weird things happen. The nearby contract can trade richer because immediate metal becomes more valuable, or financing tightens and the convenience yield changes, or you see the basis behave differently because demand for physical settlement rises. You don't need to obsess over jargon, you just need to understand this. If the market is merely excited, the curve usually behaves normally. If the market is strained, the curve starts acting like it's short on something. Time, metal, balance sheet. And that's where the real signal lives. Let's do the simple so what translation. If spreads and carry are tightening in a way that suggests immediacy is being bid, it forces participants to do one of two things. Either deliver metal or pay up to roll their exposure forward. If you are short nearby futures and you don't want delivery risk, you roll. That's buying back near and selling deferred. If lots of people do that at once, it can distort the curve and create more near-term buying pressure. If you are long and you want metal, you don't roll. You stand for delivery or you source physical elsewhere. Either way, balance sheets get involved. Warehouse stocks and deliverable categories become relevant. This is how a paper price gets disciplined by reality without any grand conspiracy, just through settlement mechanics and incentives. Now zoom out to the debt angle again, because this is the macro spine that makes $600 plausible. Governments fund themselves by issuing debt. When rates were near zero, interest expense was a manageable footnote. As rates rose, the cost of rolling old low-rate debt into higher-rate debt became a real budget line. Publicly available, fiscal data shows that interest expense has been rising over time as debt levels and average rates change. That's not ideology, that's arithmetic. And when that arithmetic becomes uncomfortable, policymakers face a set of choices that markets price in advance. Accept higher borrowing costs and tighten fiscal policy aggressively, or find ways to suppress the cost of funding through policy easing, financial repression, or inflation tolerance. Markets don't need the choice to be announced. They just need to believe it's likely. And gold is the asset that responds when the market senses the easy way out is becoming more attractive than the austerity way out. And here makes the uncomfortable part for skeptics. Gold can rise even if real yield's done to collapse right away, because the reason for buying isn't only rate math, it's confidence math, it's collateral trust, it's do I want my entire safety net to be someone else's promise? When that question spreads, especially across emerging market reserve managers and sovereign institutions, the gold bid becomes less price sensitive, it becomes strategic. And strategic bids don't disappear because of one hot CPI print. They step in on dips, they accumulate. They treat volatility as an entry tool, not a reason to panic. That's why the dips can feel shallow in a structural bid environment. But that's not the part that matters. The part that matters is how these different proof points stack together, because no single argument carries a $6,100 claim. You need layers, you need mechanics, plus behavior, plus symptoms. So let's stack them. First layer, chart structure. When an asset starts making higher highs and higher lows in a stair-step pattern, it often signals that dips are being bought quickly and that sellers are not confident. It also signals that the market is repricing in levels, not in smooth curves, often a sign of liquidity pockets and forced activity. Open interest and volume in futures can climb during rallies, showing that participation is active and that the derivatives layer is involved. That can create both fuel and fragility. Fuel because positioning adds momentum. Fragility because crowded trades can unwind violently. Sixth layer, physical symptoms. Premiums, availability, refinery throughput constraints, and procurement behavior can tighten quietly even when the screen price looks orderly. And when the market senses physical friction, it stops treating gold like a toy and starts treating it like inventory. Inventory assets behave differently. Seventh layer, cross-market confirmation. Gold's message is strongest when other stress thermometers also show tension. Currency volatility, funding pressures, credit spreads widening, or policy rhetoric that hints at prioritizing growth and fiscal stability over a pristine inflation fight. You don't need all of them at once. You need enough to suggest the regime is shifting, and that's where the real pressure starts. Now let's talk about the $6 to $100 pathway without turning this into fantasy. $6 to $100 is not a guaranteed destination. It's a scenario that becomes plausible if certain mechanisms line up. Think of it like a ladder, not a rocket. Rung 1 is already visible. Acceptance of higher prices. The market has already adjusted its reference points upward. Once an asset trades in a new zone for long enough, buyers stop waiting for the old price that never comes back. Rung 2 is the flow flip. ETFs steady to positive, plus continued central bank accumulation. That combination creates a persistent bid that makes pullbacks shorter and less comfortable. Rung 3 is the curve and carry behavior. If spreads and financing signals start suggesting tightness or immediacy, it can force more near-term buying and discourage aggressive shorting. Shorts don't like markets where their role becomes expensive or their delivery risk rises. Rung 4 is options. Reflexivity. If price moves through major psychological and strike levels into expiry windows, dealers can be forced to chase hedges higher, creating the kind of acceleration that makes targets look like inevitabilities in hindsight. Rung 5 is macro catalyst. Not necessarily a meltdown. Sometimes it's a policy pivot, a shock in funding markets, a flare in currency stress, or a wave of issuance that pushes yields up and forces rhetoric to change. Debt crises rarely announce themselves with a siren. They show up as temporary measures and market functioning tools. And gold listens to that language very carefully. If those rungs align, $6,100 is not outrageous. It's a number that can be reached through a few successive repricings, each one rational in its own moment, even if the total move feels insane when you zoom out. But here's what people miss. The move will not be smooth. Even in a structural bull market, gold will whip around violently. It will drop $100, $200, sometimes more, just to make sure the maximum number of people lose conviction. That doesn't invalidate the thesis. That's how the market tests it. The next detail is what flips the whole setup, how you respond to that volatility. This is the viewer psychology shield, and it's not optional because it's literally the edge. Volatility is a weapon, not a conspiracy weapon, an incentive weapon. If you're over-leveraged, volatility forces liquidation. If you're emotionally undertrained, volatility forces capitulation. If you chase breakouts without a plan, volatility forces regret. And regret is how you hand your position to someone with a longer time horizon. The market will do this with headlines too. You'll get a scary bond auction story at the low of the day. You'll get a gold crashes headline on a normal pullback. You'll get a gold is overbought segment right before a squeeze. The trick is to separate trend signals from noise. Trend signals are structural. Higher lows over time, persistent institutional demand, curve behavior that suggests tightness, flows that build rather than fade, and price reactions that recover quickly after dips. Noise is the intraday spike, the emotional headline, the one data print that people pretend changes everything. If you confuse noise for trend, you'll get played. And if you confuse trend for noise, you'll miss the move. That's the trap. Now, you need the two-scenario lens because credibility lives here. Scenario 1 is the controlled pullback and retest. Gold pulls back into a prior breakout area, maybe after an expiry window or after a sharp run, and it tests support. The tape looks ugly for a few sessions. Commentators get loud. This is where weak hands sell. If the thesis is intact, you'll see the pullback get bought with purpose, spreads behave constructively, and price reclaim key levels quickly. That's confirmation. It's not fun, it's not cinematic, it's real. Scenario 2 is the continuation squeeze. Gold doesn't give you the clean retest, it grinds and snaps higher in thin liquidity, often around a calendar trigger, month end, expiry, a weekend gap, a sudden policy remark. This is where people who waited for the pullback get forced to chase, and where short exposure becomes combustible. This scenario comes with gap risk. It also comes with emotional risk because it tempts you to abandon discipline. Both scenarios can happen within the same month. The key is to know what confirms each, and that's where we get concrete. So what should you watch next, right now, this week, and into the next couple of weeks? Watch 3 categories: levels, flows, and the signal that can't lie. Levels first. In a market like this, the big psychological number is obvious. $5,000 is a magnet because humans love round numbers and because options and positioning often cluster there. If gold holds above that area on dips, or if it breaks above and then refuses to fall back for long, that SA behavior will tell. It means the market is accepting higher prices, and dips are being treated as inventory opportunities. Another level to respect is the most recent swing low after a sharp push higher. That swing low is the line between healthy pullback and trend damage. If that breaks decisively, it doesn't mean the long-term bull case is dead, but it does mean the near-term squeeze energy is cooling, and you should expect more chop. Because if this one level breaks, the math changes. Flows second. Watch ETF behavior and any signals of institutional allocation. You don't need to see it every day. You need to see the character of it. Are dips being met with accumulation or with outflows? Are rallies being sold or chased? You'll often feel this in the way price behaves around support. Does it bounce quickly or does it grind lower? Now the signal that can't lie, the curve and the spreads. If the market is truly strained, you'll see the nearby contracts stay bid relative to deferred, or you'll see carry behave unusually given rates. Again, you don't need to become a quant. You need to respect that time structure is the truth serum. If spreads are calm while price spikes, the move can be more speculative. If spreads tighten and nearby strength persists, it suggests demand for immediacy or balance sheet constraints. Exactly what you'd expect when debt stress and collateral preference are leaking into gold. Now let's address the counterpoints, because pretending there are none is how you lose trust with serious people. There are real ways this can stall. A sustained, credible spike in real yields can pressure gold, especially if it comes with a stronger dollar and tighter financial conditions. A sudden political shift toward aggressive fiscal tightening, if it's credible and durable, could reduce the fiscal dominance narrative and cool the bid. Coordinated liquidity support and calm in funding markets can temporarily lower the urgency to hold gold as collateral insurance, and physical tightness can ease if supply chains adapt, recycling increases, or demand shifts. Those are real. But here's the key. Many of those counterpoints are short-term breaks, not long-term reversals, unless they persist. The market doesn't need a perfect environment for gold to rise. It needs an environment where confidence in paper promises is questioned often enough that gold stays on the shopping list. And this is where institutions get trapped by their own incentives. They may not want to talk about debt risk openly, but their actions reveal the pressure. If forecasts keep ratcheting higher, if clients keep asking about allocation, if central bank buying remains consistent, the base case becomes gold is no longer a minor diversifier. It becomes a core reserve asset in the minds of more participants. When that happens, the upside tail gets fatter, not because of hype, because of portfolio math. A small percentage shift in enormous pools of capital can move a market that S small relative to global financial assets. That asymmetry is the silent engine. So how does $6 and $100 actually arrive without magic? It arrives in bursts. A push through a psychological level triggers options hedging. A month-end rebalancing wave turns into a flow that doesn't reverse. A policy remark changes rate cut expectations by just enough to ignite positioning. A weekend gap in thin liquidity prints a new high, forcing shorts to cover into a market with shallow offers. Each step feels reasonable when it happens, and outrageous when you add them together. That's how repricing works. That's how the market keeps most people emotionally late. Now, I'm going to give you the practical roadmap, the kind that keeps you from getting whipped out. You need a base case target zone, an invalidation level, and a next week checklist. Base case target zone. In a structural bid environment with continued flows, the market will naturally start treating the mid-5,000s as the next normalization, especially because major institutions have already floated targets around that zone for the end of 2026. That's not a guarantee. It's It's a reference point that influences behavior. If momentum and reflexive hedging stay hot, and if the curve Triarch funding signal supports stress, the upper tail expands toward the low 6,000s. That's where $60, $100 lives, not as a daily prediction, but as a plausible squeeze and repricing waypoint if the chain stays intact. Invalidation level, not gold goes down a bit. Volatility is normal. Invalidation is structural damage. The cleanest practical invalidation is a decisive break of the last major higher low on the daily structure, accompanied by a cooling of the stress signals, spreads relaxing, flows turning negative, and price failing to reclaim key levels quickly. If that happens, the near-term squeeze story weakens, and you should expect a longer consolidation rather than a straight run. Next week checklist, watch how gold behaves around $5,000 as a psychological and options-heavy zone. Watch for any signs of calendar forcing, expiry dynamics, month-end behavior, thin liquidity sessions. Watch for cross-market stress, dollar behavior, rates volatility, credit tone. And most importantly, watch the curve and carry behavior, the signal that tells you whether the market is paying up for time and immediacy or just marking up a screen price. And here's the final warning, the quiet one that saves people. Even if the thesis is correct, the path will be violent. You can be right and still get shaken out if you treat every red candle as proof you were wrong. The market will try to make you feel stupid for being early and then punish you for being late. That's the game. Your job is to stop playing emotionally and start watching the mechanics. Because the people who win in these regimes aren't the loudest bulls. They're the ones who understand what participants are forced to do when spreads tighten, when hedges turn reflexive, when debt math starts dictating policy, and when physical reality starts vetoing paper convenience. If you're here because you don't want the bedtime story version of markets, you're already ahead of most of the crowd. Stick with the process. Watch the signals that can't lie. Respect the two scenarios, and don't let volatility rent space in your head. Use it as information. Because if this repricing is real, the next big move won't feel comfortable, and that's exactly why it can happen.